Domino's Pizza, the stock I have been asked most to review. Today we're going to take a look at this very interesting stock. You don't want to miss today's episode. There is a lot to uncover. We're going to take a look at the historical prices of Domino's. We're going to take a look at their balance sheet. We're also, as always, going to take a look at that dividend safety, some really key financial metrics. And as always, we're going to end with the stock valuation model and find out what our acceptable buy price will be after using our margin of safety on that intrinsic value. So let's jump straight in. So far year to date, the stock is down just under 12%, sitting right towards that 52-week low. We can see that yield of 1.6%. And for those who have been holding that Domino's company for 10 years, well, look at that 402%. So very interesting. It's had a lot of growth over the last 10 years, and that does not include the dividend. So lots of growth for a company like Domino's, which I'm sure most of you know what they do. So what I want to do is quickly jump into the income statement and take a look at their revenue growth over the last 5 years. What we can see, 2018, 3.4 billion, and in their most recent report, January 23, 4.5. So for me, I like to see this. There's that steady, moderate growth year on year, as we can see over the last 5 years. And what I would like to see if we scroll down is the same with their net income. So if we look at their net income, we can see that this has gone up from 362 million to 452 million, in line with their increase in revenue. So far, these are positive signs, in my opinion. Now, very quickly, I want to look at the balance sheet and just take a look at their cash and total debt to see how the company is. Now, cash 25 million in December 2018, and in their latest quarterly report, 154 million. So as we can see, fairly cyclical up and down, and around 154 million currently. So nice growth over the last 5 years. However, year on year, there is some movement. So now I want to take a look at the total debt. And as we can see when we scroll down here, the total debt, 3.5 billion 5 years ago. And in their latest report, 5.2 billion. So their total debt has increased. Does this worry me? Well, we're going to take a look at the financial metric to see whether or not they can pay off this debt. From what I can see so far, it looks like that shouldn't be a huge problem. Now, jumping into their dividend safety, 55 borderline safe. It's not great when you see the word borderline safe. You really want to be buying companies that are safe or very safe. So we'll take a look at this. Market cap, 10 billion, large cap. So let's dive a bit more into those metrics. Now, what I think is key here, so they've paid a dividend consecutive for 9 years without a reduction. So not that many years compared to other stocks that we typically review on the channel. And then if we take a look at the recession dividend, so there was no dividend paid during that period. They did have negative 5% growth, which was above the growth during that period. However, what we can see here is that the return of the company did return lower than the S&P's 500 of negative 55%. Now, overall, it may not look great, but one thing just to remind you is that if you had been holding this for longer than the recessions over the last 10 years, you would have eventually had 402% growth. Now, what I think is key is when we look at their dividend growth, what we can see is they did start doing a dividend in 2004, which was maintained in 2006. However, they then cut the dividend and only really started this from 2012. So there was a period of 5 years where they did not pay a dividend. However, over the last 5 years, they have been growing that dividend double digits, 19%. Their latest increase of 10%, which I really like to see, double digits. Now, as you know, I always say minimum 4%, as that's the US inflation rate over the last 30 to 40 years. So if you're hypothetically getting a 1% dividend increase, you are essentially losing money, losing purchasing power. So what I would say is this is very positive to see. However, I would like to see at least another 5 years forward-looking data to be able to understand whether or not this is something that I would invest in right now. But let's take a look. Maybe we can be convinced otherwise. If we look at the dividend yield theory, as always, dividend yield theory states that when the yield, which is currently at 1.6%, sits above the 5-year average, which is 0.9%, then this is undervalued. So that's one sign of undervaluation. Remember, we never look at one model in isolation. So if we look at the forward PE, again, another sign of undervaluation as the forward PE is below the 5-year average of 29.3. What we can see in the sector PE comparison is that Domino's 22 is higher than the consumer discretionary. However, we're going to take a look at this in detail in one of our valuation models. It's sitting towards the very end of that 52-week low. However, it does not mean it is undervalued. Likewise, if it was sitting at the 52-week high, it does not mean it is overvalued. Now, earnings payout ratio and free cash flow payout ratio. As you know, I only like to look at the free cash flow payout ratio as the earnings is susceptible to manipulation through earnings and accounting. However, for the investors that like to see it, I like to see below 60% across the board. In fact, just so there is room to grow that double-digit dividend. What we can see here is it has happened over the last 10 years well below 60%, and again for the free cash flow payout ratio below 60%. Their latest was 41% in 2022 for the free cash flow. So for me, that's very positive and shows there is room to continue to grow that double-digit dividend. Moving on to the earnings per share and the free cash flow per share. Likewise, I prefer to look at the free cash flow per share. However, we can touch upon the EPS. 2013, $2.45. 2022, 12.5. That is some great growth, and I would like to see that continued. However, that is a very positive sign for a company if they're continually growing their EPS. Likewise, that extends to their free cash flow per share. $2.78 in 2013 and $10.90 in 2022. So lots of positives in my opinion so far with Domino's. With a company like Domino's, 3 to 7% growth, we can see here across the board they have done that very well. Some years a lot better than others. However, when we then look at their total sales across the 10-year period, and what I'm doing here is I'm looking at these statistics, these metrics over 10-year period. Personally, for me, as a long-term dividend growth investor, I want to be investing in companies for the foreseeable future. So really a minimum of 10 years is what I'd be looking for. If 5 years, it really depends on the investor. So as we can see here in 2013, 1.8 billion worth of sales. 2022, 4.54 billion worth of sales. So that's very positive, almost 3 times growth over the period. So that's very positive to see as a shareholder. Now you know shares outstanding. We love to see when companies are returning excess cash to shareholders as they are essentially reducing the number of outstanding shares, increasing your ownership within the company. So what we can see here is in 2013, 57.7 million shares outstanding, 2022, 36.1. So I really like to see this graph as a potential investor where the shares outstanding is declining. Now, other good examples of this, if you want to go and check out one of my other videos, is CNI, Canadian National Railway. They do this really well, like do Lowe's, which I just dropped a video on yesterday. Return on invested capital. Now, again, I'm looking for a minimum of 10%, more specified 12% for restaurants. And as we can see here, Domino's do that very, very well. So they are very well at allocating their capital. That is the management. So very positive to see here. Operating margin above 16% is what we like to see. And free cash flow margin above 5%. So it's a very well-run business, in my view, from what we can see so far on these metrics. Now, one thing to note here, we did touch upon it earlier in terms of the debt levels. So this net debt to earnings before interest, tax, depreciation, and amortization shows the number of years a company would take to pay off all their debt net of cash. Now, as I did mention earlier, when we saw that the total debt was increasing, we want to ensure that the company is able to pay off that debt. If it's increasing, it's not always an issue. But what we can see here is our preference is to be below 3.5, so 3.5 years or less. And it has consistently been above that and has started to increase. So one thing I would like to see over the next coming years is this reduce. Otherwise, for me, this is a potential red flag in that they may not be able to cover their debt. Net debt to capital, as we can see here, it is 0. So far, I think there are some conflicting information in terms of whether or not it's a buy or sell. I think the one thing that will really help is our stock valuation model and finding out if it is undervalued. As always, smash the like button, smash the subscribe button if you're enjoying the content as we move on to the valuation. And if you want to grab yourself a copy of this sheet, do check the pinned comment. Now we're jumping in straight to Graham's valuation. We input the earnings per share. We have the growth rate as estimated by Wall Street analysts for their target. and we input the current yield on AAA corporate bonds, which has come down over the last few days. This gives an intrinsic value of $218.56. Now, just a reminder, the current price is just around $300. Now we move on to the multiples valuation model, where we get companies in a similar industry and similar size. We have McDonald's, Yum Brands, Starbucks, and Papa John's. We then input the stock price, the earnings per share, and this gives us our PE multiples. We then get the average PE, which we multiply by Domino's current earnings per share, and this gives a stock price per multiples valuation model of $412. Now, the dividend discount model, what this really shows when we put the yearly dividends is the growth rate per year. And as mentioned earlier, very positive to see average growth rate over this period around 17%. Using the formula where we're essentially getting the value of next year dividend by getting the yearly dividend for the most current form, multiplied by our expected growth rate over the cost of equity less the growth rate, we get our DDM price of $345.25, so upside to the current share price. And we've used a growth rate of 7%, which I believe to be on the more conservative side, as what we can see right now is good double-digit dividend growth. So I'm expecting this to potentially start to slow down. However, that is a conservative estimate on my part. Now we move on to the final model, the discounted cash flow model. We have the free cash flows year on year, which we then get the growth rate year on year, which shows at around 15.8%. We then use a growth rate. I've gone for 12% below the average growth rate, again to be on the more conservative side, which gives us our future free cash flows. And using the discount rate, we get the present value of these future free cash flows. We then sum this with the cash, subtracting the total debt, and arrive at our equity value. One thing to note is they have 35 million shares outstanding, so once we divide that over the equity value, we get a DCF price of $265.89. Let me know your thoughts in the comments, whether or not you're expecting these prices or whether or not they don't surprise you. So we've averaged these four, which gives us the intrinsic value at $299.21. Now, the current share price is sitting around $300. And what we're effectively trying to do here is calculate our buy or sell price. So with a margin of safety, I typically look for good companies, strong companies that have wide moats at around a 10% margin of safety. Different investors, some could have a 20%, some could have a 15%. So for those that are looking for a margin of safety of around 10%, your buy price would be around $269, which, as we can see here, is slightly below that 52-week low. However, given it is downtrending, it could reach that point. If you were looking for a larger margin of safety before entering Domino's, you'd be looking at around $239. Again, well below that 52-week range. However, it's not to say it won't hit that target, as it was around that in 2019. As always, Wall Street price forecast for the next 12 months, some upside to the current share price at around $345.45. As always, smash the like button, smash the subscribe button. Let me know your thoughts on this comments. Let me know your thoughts for ideas on upcoming videos. And as always, have a lovely, lovely day.